You open an app, tap a few buttons, and a new phone or a week's worth of groceries arrives at your door in minutes. India's quick commerce sector turned this hyper-convenient premise into a daily reality for millions. To pull off that speed, platforms moved away from the traditional massive fulfillment centers on the outskirts of towns. Instead, they built dark stores, small warehouses located just 2 to 3 kilometers away from the residential neighborhoods they serve. But that convenience relied on a grueling pace for workers. In January 2026, protests over rider safety and fatigue pushed the Union Labor Ministry to intervene. The government banned 10-minute delivery marketing claims overnight. Without the promise of impossible speed to lure in customers, delivery times now average 15 to 20 minutes. Investors have stopped looking at growth charts and started demanding actual financial returns. The entire sector is consuming immense amounts of capital. Success in 2026 is measured by operational efficiency, balancing the cost of every rider and dark store against the revenue of each delivery. While the major platforms offer nearly identical 15-minute delivery windows on your screen, their ledgers show different levels of cash reserves and net losses that will determine which names disappear by the end of the year. In this matured landscape, scale alone does not guarantee dominance. To turn a massive store count into a competitive advantage, a company must master cluster density and per-order profitability. Take Swiggy Instamart. With roughly 1,136 dark stores and deep integration into the broader Swiggy ecosystem, they have significant reach across the country. This chart shows Swiggy Instamart's financial impact on its parent company. In Q3 of FY26 alone, the platform posted an adjusted EBITDA loss of 908 crore rupees. To increase the value of each order, Instamart has expanded into electronics and appliances. However, their dark store edition has slowed down, and they continue to lag behind their peers in per-store efficiency. Because the platform has not yet reached per-order profitability, Instamart has become a consistent financial drain on Swiggy's overall balance sheet. Then there is Zepto. Driven by aggressive founder-led execution, this platform operates a stable network of 1,100 to 1,150 dark stores and maintains a strong hold on the Gen Z market. This visualization illustrates Zepto's operational strength. Their pillar shows 2,284 daily orders per store, double Instamart's volume. However, look at the base. Moving that much volume at current margins costs Zepto 3,367 crore rupees in net losses for FY25. To prepare for a planned 11,000 to 12,000 crore rupee IPO by mid-2026, the company is now tightening its operations to reduce that burn rate. Zepto is racing against its own burn rate, betting that it can secure this massive cash injection before its current losses become fatal. Finally, we have Blinkit. Backed by Zepto, they command roughly half the market and operate the country's largest network of over 2,000 dark stores. Rather than chasing sheer geographic spread, Blinkit focused on cluster density, grouping stores together to lower delivery costs while expanding into higher-margin product categories. This line graph shows the result of that strategy. While its competitors continue to bleed cash, Blinkit's margin line has crossed into positive territory, reaching profitability in recent quarters. Zomato's deep cash reserves allow Blinkit to play a disciplined long game, scaling its infrastructure without the immediate pressure of a survival-based IPO. By prioritizing dense urban infrastructure over reckless expansion, Blinkit is proving that the dark store model can actually generate a profit at scale. By April 2026, quick commerce has transformed into a highly disciplined, low-margin retail operation. Software alone cannot bypass the physical limits of the business. Managing inventory wastage and navigating crowded streets are real-world constraints dictating the bottom line. For investors, high gross merchandise value is no longer the primary goal. The focus has shifted to contribution margins, the actual profit made on a single order after paying for the rider and the warehouse. The three current leaders face a shrinking window to stabilize their unit economics. Retail titans Amazon and Flipkart are already testing their own dark store networks, ready to enter the hyper-local market. In the coming months, we will see if Blinkit's lead is uncatchable or if a successful IPO will give Zepto the resources it needs to reset the board for a new war.